Hey everybody, welcome back to the channel. The 17% yield income ETF that nobody is actually talking about. This one here has a high income, a strong strength, and real results. Paying up to a 17% in monthly income. It's built for today's markets. It's got the option strategy of generates cash flow. It's diversified, tax efficient, investor friendly, and ideal for retirees and income investors. We're going to break it all down today for you. And you start asking yourself, why would I be talking about a 17% yield? Because I don't chase yield. And I tell you, stop chasing yield traps, discover true income potential across the board. We're going to break this all down for you today and give you something that no one's actually talking about in these type of funds. So grab your mug, fill up with your favorite beverage, sit back, relax, and let's get on with the video. Important disclaimer, the content is for educational and informational purposes only. This is not financial advice, and past performances do not guarantee future results. Hey guys, before I make any big things in the video, just gotta say, if you don't have your mug, don't be afraid. You can get one right here. They're easy to get. This supports the channel. I'm not sitting here just pushing mugs. My whole thing is we're just helping support the channel, keep the thing going so we can keep making these great videos for you, because we don't take advertisers. We don't take support from anyone else because we want to stay as biased as we possibly can. I want to give you the true Doug answer of every one of these type of funds. So you want to use the QR code, you want to use the links down in the description, you can go ahead. They'll take you right to the website where you can order all of these, anything that you want. They make great gifts all the way through. Now, you probably heard the story already, but I went to my truck and I dropped my coffee mug and it shattered all over the ground. So I said, why don't we have a 40-ounce travel mug? Well, instantly we got them ordered, got them rolling, and here you are. It keeps warm stuff warm, keeps cold stuff cold, double-walled installation. It's an awesome piece. We just added it. Don't be afraid to add that to your collection. So the essential question we're going to ask, can a 17% income ETF support retirement without sacrificing the portfolio? Well, first off, the retirement goal. The goal is a paycheck that can continue, not simply the highest displayed yield that's out there. And when we start seeing 17%, I start getting nervous. I start getting worried about this and saying, whoa, 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 slow down, Chester, because 17% can get us into a scary point. So we got to make sure we got income generation. We got to look at how does the monthly paycheck, how does it manufacture under the hood? How does it give me that money? And we got to look at the yield versus return. Remember that. That 17% is the yield. That's great. But what's the total return number? How does this fit into the bigger portfolio package? Are we seeing actual growth? Or is the NAV fallen? Are we getting a 17 income, but we're losing 5-7% in the growth side? And then how does the taxes hold up on this? How are they dealing with it? Is it a 1256 contract or is it ROC? How are they dealing with that? And then what's the risk assessment of all this? Now, if this is in the Nasdaq 100, the volatility and the choppy upside, I want to know all this stuff about it and how is it going to play into our retirement role? These are the questions we ask, why we ask the tough questions before we do anything. So what's the fun? Well, it's TAP Alpha's TDAQ, the Innovative 100 Growth and Daily Income ETF. Now, don't let that daily income fool you, because all that means, and I'll explain it here shortly, is how they adjust their package and their options on a daily basis. But TDAQ, it's a fund that's been out there. A lot of people don't talk about it anymore. They're just quietly eating up people's lunches. And when I say that, that means other ETFs. They're taking away some of the market share. So what is TDAQ? It's a TAP Alpha Innovation. Innovation is the word for Nasdaq 100, so they don't have to pay their fees. It's a 100, the growth and daily income. This fund opened up September 4th of 2025. So we're just getting darn close to 1 year. And I think that's what a lot of people are waiting for, is that 1 year celebration to see what the numbers actually do. The current income generated through a proprietary daily option overlay and the capital appreciation that maintains potential for growth in that Nasdaq 100 exposure. The core strategy, TDAQ, is not a pure high yield strategy designed to sacrifice nearly all the growth in the exchange for a massive payout. The fund seeks to provide a sweet spot for retirement investments. It's a significant monthly paycheck while still participating in the long-term innovation of the tech sector. So when we pop the hood of this one, I know you guys love my designs here, but let's pop the hood under this one. The core holding, they're going after QQQM, okay? They're buying that index, which is basically the second version of the QQQ. It's a 99% of their portfolio is into that core holding. Assets are up to $266 million and they haven't even hit their first year yet. Expense ratio though, you're going to see different things posted, but the actual total expense ratio is 0.83. And they've already established 9.96 million shares outstanding already. So under the hood, it looks like they got some good power behind them. They got some good assets there. The expense ratio to me is a little high for long-term carrying, but if they can produce what they're saying, everything works out in the long run. So what do? They do the daily 0 DTE engines, which is 0 days to expiration. Okay, the daily strategic part is TDAQ, harvest income by selling out of the money, OTMs, call options that expire the same day they're written, resetting the cycle, trading every morning. They use the Nasdaq 100 core exposure. So they're doing the options premium written on QQQ, QQQM, and the related indexes. Okay, and it's the dynamic strike. The strike is generally set between 0 to 5% out of the money, factoring market volatility and historical trends. So let me explain to you here when we say the daily income. This is not something that they're paying daily distributions. What they're doing though is, think about this in the morning. They get up in the morning, they go to their office, they got their Doug retirement cup in their hand, they sit at their desk and they say, today TDAQ holds Nasdaq 100 QQQM, the core, and sells out of the money OTM call options. So they set the price that they want. The buyer pays TDAQ the upfront cash premium, and that premium is retained regardless of price movement. And in the intraday management, if the Nasdaq shows that below the struck price, the option expires worthless. Now TDAQ keeps the 100% of the option premium for anybody who did buy it. And the next day they start the whole process over, they reset, and they move on. So my graph shows you the simplest thing. At 9:30 they set the price. This is what the QQQM price is at. So they're going to set up a premium, their strike price, which is the red line. And as long as they sell one and that price doesn't get to the red line, they keep the premium and everything's fine, and they start over at the next day. And they can reset that strike price. Maybe they see the market's going to fall, so the strike price gets lowered. Maybe it's going to climb, so they'll climb the thing up even higher. What that helps do is generate more income. It doesn't cap it. So many companies do this that they set the strike price and it's set there for a month. It's because they set the buy and package and all that kind of settings. They set it for the month. They may set it for the week. These guys do it on a daily basis. So why they do daily? The 0 DT advantage. Traditional monthly calls, multi-week exposure to a single strike price. The time value decays slowly every week. It's locked in. It's less flexible. It's adjusted for volatility. While TDAQ's daily side resets every trading day for maximum agility. It harvests rapid decay in final hours. And the strike selection adapts to the market conditions. So as I just said earlier, they're able to adjust every morning and every afternoon to where they want the fund to be, to try to pick up as many people to buy it to generate that premium. So 17% yield, what does it really mean? The forward distribution rate right now is 16.94% at the close of the market on July 17th of 2026. Now, that's forecasting all the way out. That's an annualized snapshot. That 17% figure represents a forward-looking calculation based on the most recent monthly payments. It assumes that the rate will continue for the next 12 months relative to the current share price. Now, I got to put a big mark on this. This is not guaranteed. Monthly distributions are variable and depend on the success of those zero DTE option strategies. A forward-looking rate is a snapshot, not a promise. Okay? So, some of the key dates here in July. July 14th was the X date. July 15th was the payout, which is why we're doing this video here to show you the 17th, what they did. Last month was 39 cents. The estimated 39 times 12 is 468, and their price share is between $26 to $27 range. This is where we're getting our 17% price bump. So I look at this and say, boy, this would be an opportunity if someone's buying this on a dip, when it's down to maybe around that 26, below the 26 range, picking up some extra shares, and you're going to be continuously improving on your distribution yields. But as you know, on this channel, right now, I'm not excited because 17% is a great number. I still got to see the total return number. Is this fund actually producing, or are we just trading and faking it out? So forward versus trailing. So forward distribution rates, this is basically what I'm going to say is we're looking out to that 12-month period to get to 17. Up to today, they're already at 14.12%. We look at the recent distributions, 35, 38, 40, 39. We're coming up with that 39 cent as the average across the board. What will this mean if you had $100,000 invested into it? And theoretically, you're looking at a monthly paycheck of about $1,417 on a $100,000 investment. That's some big numbers, guys. But remember, this is a limited operating history. We don't have a full 12, 24, 36 month history to base off of. We don't have a bear market or a downward trend market that we can look back and say, oh, it handled it well through this package. But it does have all the pieces and all the flexibility to make those changes. Now we're going to start talking some of the stuff Doug always wants to go with, the growth and the NAV content. When this thing opened up back in September, it was $25. Today, as of July 17th, it was $26.43. That's a 5.7% growth across the board, plus adding in your $3.73 in distributions. So far, it looks promising. A standard price only chart significantly understates the fund's actual performance. The price appreciation of 5 to 6% occurred alongside the monthly income generation. So NAV stability indicates that the 17% is not currently eroding the core investment. So what it's meaning is that 17% is your true 17%. But we have to make sure that this thing can continue on. The zero DTE strategy converts potential Nasdaq 100 upside into immediate cash. Selling calls that may cap the participation in the powerful rallies, and a strong goal is a paycheck portfolio that maintains the principal over long time. Now we're going to talk to you a little about total returns. It's the complete picture. So for anyone who doesn't know what total return is, total return measures the actual wealth generated by the investment over time, according to for both growth and income. So what happens if you have a price change, distribution, and then if you have a reinvestment effect, makes for some big differences. So since inception, September through July, it's got a positive 23.6% total return. If we look at just 2026, which is January 1 to July 16, we are looking at a 13.5% total return. So numbers look impressive, as we say. Okay, so we're looking at a positive total return number. So that's another good thing for myself. But I broke it down this way. Someone says, well, 23%, how does this all work? Well, 100% right off the bat is your initial investment. Then you have price share gains, growth of 5.7%. You have cash distributions of 14.9% since inception. Plus, you have reinvestment effects of 3%. If you remember back a couple of videos ago that I said, if you do some simple math, you can get yourself close in the ballpark. Never perfect, but close. If you take your yield plus or minus your growth, it'll give you a number. So right here, we're at 19, well, let's do it this way, 20.6%. Okay? So the yield I'm telling you is 23.6. So how am I off 3 percentage points? Well, it's the reinvestment effect. If you actually reinvested the dividends back into it, you're picking up another 3%. That's why when you do total returns, you got to question, is it reinvestment effect or is it not reinvestment effect? Most of the stuff I read and most of the stuff I put out is always reinvestment affected because you're just continuously rolling it through. So you take off your 100% from the total return, it gives you a 23.6%. Just a little more education for you. Now taxes. Now it doesn't matter how much you pay me, it's how much I keep. So if the tax is going to eat us alive, then it's not worth it. And here's what we run into. The distributions are a big mix. There's underlying dividends and collateral interest. It realizes short and long-term capital gains. It has option premium gains, and it uses return of capital. So they have a big mix of tax pot to work under. So understanding the ROC, we've covered this almost every video. It basically is return of capital, which is a classification of taxes. There's a good side and a bad side, and they're using it in the good side. Is that basically the distributions that they classify as ROC gets removed from your initial price. So if you paid $25 for a fund and you got $2 in distributions, you would have adjusted base of $23. Simple. So that defers your taxes down the road until basically when you sell it. But now you got to remember one thing. Section 19A notices, estimates some of the payments as potential ROC. You don't know what that real number is until you get your 1099 form. So your 2026 data provides a 1099 DIV at the end of the year. That's when they can tell you what's going on. Now, don't assume the 60/40 1256 contracts are treatment for all income. So this one does use some 1256 sections that we see a lot of in NEOs, but you can't guarantee that. So this thing is a mixed pot. Why I said this, it's the distribution best mix. You have underlying dividends and collateral interest. Those are probably going to come to you as what we call ordinary income. You're going to realize the short-term and long-term capital gains, which are going to be that 1256 section contracts, portions of that when they're selling on indexes. You're going to get the option premium gains, which are going to come into you as return of capital. So you do have a tax harvesting piece of the puzzle across the board that can help reduce the taxes on the total package. The major risks, and this is a big one here, the major risk of the fund right now. It's all Nasdaq concentrated, 99% in that QQQM. Now, I call that a high impact risk because you're really putting it into what happens with Nasdaq. So some things I like, some things I don't like, but this is a lot of these funds operate this way. But I gotta tell you, it's a high impact when you're into one category. You do have upside potential. Selling daily out of the money call limits the participation in sharp market rallies. But at the same time, I'm not trying to be a positive, negative type guy here, but at the same time, they're changing every day that they may be able to capture some of it. But I put this as a moderately high cost opportunity. Distributions, income stability, it's variable. That 17% can change if the market changes. It's not guaranteed. NAV erosion and ROC risk, well, they're always going to be out there. Because when you put ROC into any package, you're going to have some NAV erosion that could potentially work. And when you're getting up to the higher numbers, like the 17%, could affect the fund. We showed that it hasn't yet, but it could. That's why I got to keep it out there. And then again, we only have a short history. We don't have a lot of history to work off of. So you got to understand that this is potential of a problem. So in a retirement portfolio, where would you put this? Well, TDAQ apparently is a diversified income bucket component. Now, why I say diversified? It's not a standalone retirement piece. And I personally, because it's so new and so short, I really put this, it goes into the income bucket, but I actually put it as a satellite piece, not a core piece. So what this is, a satellite piece to help boost my income. Okay, if you need a boost in income, this is the baby you want to put into it. This is where you want to add that part of it. Because its strength is it has that Nasdaq 100 exposure. Okay. It does have the 0DT flexibility with the daily resets. It has given you a high income at 17%, and the NAV appreciation so far has been a positive across the board and a strong total return in its category. That's where I would put this as a income satellite piece, which means you have a core that you're operating from. So maybe you have GPIQ, the excuse me on that one, Goldman Sachs GPIQ, and you want to boost their 9% their distribution number. Well, add in this one as a core and pick up a few extra points because of that 17%. But you got to remember your concentrated risk. You're heavily into the volatile technology. You got to make sure you stay in the lines of your portfolio cap. Cap upside, you means you got to watch. You're not going to get a ton of growth. It's primarily built for income, and the payments are going to be variable. So I think we pretty much covered what we're actually talking about here and where does it fit in a portfolio across the board. So right now I'm going to ask you guys this. Leave a comment down below. I'd love to hear you. Tell me about where would you use this? Is it some of you using it for core? Some of you using it for pure income? Are you using it to boost your core package as a satellite? How are you using it? I'd love to hear from you in the comments below. So let's give you the scorecard and the final takeaway of all this. For income generation, I call it very strong. That 17% is very, very strong number. It has a growth potential, that 5 to 6% that we've seen so far. I'm saying that's pretty good. It's above inflation. It's not, it's not great, but it's good. Total return numbers is very strong from what I'm seeing. A 23.6 since inception, 13.5 over the year to date of 2026. Some strong numbers there. It puts it right into the game. The tax efficiency is variable. They got multiple things going on, multiple streams, very hard to understand. So I don't like, there's positives, negatives across the board. If you have it in an IRA or a Roth, probably the best place. I personally would put it for now until we get more history. And long-term reliability, same thing. You got to get some history under this thing. This is one that I'll say maybe broke my rule, but I brought this in only as a satellite. It's in my income bucket as a satellite. But I wouldn't be buying this just because 17%. I'd be buying this because you need something more in your portfolio. It's not a core piece. It's not a piece that you have to operate with. Let me know your thoughts. If you like what we're doing, hit that like button. Let me know your thoughts if you agree with what I have. And also, don't forget about our new travel mug. It helps support the channel. That's why I advertise it so much. But it helps support the channel, and we appreciate if you bought anything. We thank you for watching. We thank you. And if you're part of our Patreon, thank you again.